Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now, based on our latest research and analysis of the current market landscape.
This is a big one. We've synthesized a list that, balances aggressive growth, specialized infrastructure plays, and some solid defensive positioning.
Definitely a mix.
Before we get to our first pick, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's start the countdown. What's the first company on our list?
First up is Advanced Micro Devices. The reason it's standing out is its absolute acceleration and, frankly, increasing dominance in the AI and data center market.
Yeah.
We've sort of moved beyond the point where they are just a theoretical challenger, right? They are delivering hard results that really challenge the incumbents.
And what's fascinating here is that the growth isn't just about CPU sales anymore. It's the entire data center ecosystem they're building out.
Yeah.
They reported record Q3 revenue of $9.2 billion, which is up a staggering 36% year over year. I mean, that's rapid expansion.
Wow.
And it's fueled almost entirely by demand for their high-performance EPYC CPUs and, critically, their Instinct AI accelerators.
And the market validation is just key here, isn't it? You look at that landmark partnership they announced with OpenAI to power their next-gen AI infrastructure. I mean, that's not a small footnote.
No, not at all.
That is a massive vote of confidence. It signals that their hardware is structurally competitive for, complex, large-scale AI deployment.
And this is where we probably need to dive into the technical side just a bit.
Yeah.
Because when we talk about AI dominance, we often focus on training, which is incredibly hardware intensive.
For the big models.
Exactly. But the real ongoing revenue stream, that comes from inference, the deployment of those models in the real world, and advanced micro devices architecture, specifically in the Instinct MI500 series, is designed with efficiencies, the unified memory, lower accelerator latency. That makes them incredibly attractive for cloud providers and data centers running continuous AI services.
So they're not just trying to build a faster chip overall. They are building a chip that's really tailored for the operational phase of AI.
Precisely.
Where the money is made day to day. If they know that strategy, the upside is just massive.
Yeah, potentially.
So how critical is the upcoming Financial Analyst Day? That's November 11th. How critical is that for locking in that institutional confidence?
Oh, it's everything. That date isn't just another presentation. It's where investors demand tangible roadmaps.
Right.
They want to see the plan for the next-gen Zen CPUs and the evolution of that Instinct line. Analysts are already highly bullish, averaging targets over $237. If that November 11th presentation confirms they have a clear path to maintain their architectural edge, well, that target could feel conservative pretty quickly.
Interesting point.
Moving on then, my pick for the next one is CleanSpark. This one is all about exceptional revenue acceleration and their successful transition to profitability, which is somewhat rare, actually, in the highly competitive Bitcoin mining sector.
Yeah, their growth numbers are genuinely impressive, especially when you consider the volatility, inherent in their underlying commodity, Bitcoin.
Totally.
Q3 2025 revenue reached $198.6 million. That's a huge 91% year-over-year growth. But, like you said, the profitability flip is the real headline here.
Absolutely. They successfully transitioned from a net loss in 2024 to a trailing 12-month net income of $292.47 million.
Wow, that's quite a swing.
It is. That shift showcases remarkable operational leverage. I mean, for context, achieving a TTM net income of that magnitude while still aggressively scaling up, it really shows they've cracked the efficiency code somehow.
So for a company growing this fast, a forward price-to-earnings ratio of 14.48, that seems...
It looks very, very reasonable, doesn't it?
It does. And it speaks directly to their scale, which needs context. They operate at a massive capacity, 50 exahashes per second operational hash rate.
Which is huge.
For you listening, 50 exahashes per second is just an incomprehensible number. It puts them among the largest miners in the Americas. And maintaining that kind of scale is a colossal energy management problem.
And that energy management, that is their competitive moat. Crucially, they own and operate their data centers.
Instead of leasing.
Exactly, rather than leasing space from third parties. This gives them superior cost control and efficiency, particularly in power procurement.
So they can negotiate better rates?
We're talking about negotiating directly with utilities, securing long-term power purchase agreements at favorable, low-cost rates. That cost advantage, maybe shaving just pennies off per kilowatt hour compared to competitors, that turns into hundreds of millions in net income when you're operating at 50 exahashes.
Okay, so the thesis here is basically superior scale plus superior vertical integration allows them to weather market volatility better than others might.
That's the idea. So the next catalyst to watch is their fiscal Q4 earnings release, expected around December 1st.
Right.
That report needs to confirm the sustained growth and really reinforce that profitability is the new norm, not just, a one-off spike.
Okay, makes sense. Speaking of companies leaning heavily into specialized infrastructure for high growth, sometimes volatile sectors, the third stock on our list is Ondas Holdings. The key reason this company is standing out is its aggressive strategic expansion into defense, autonomy, and security tech. And it's driven almost exclusively by strategic acquisitions.
This is absolutely a high-risk, high-reward play. We have to frame it that way for you.
Sure.
They are focusing on high-growth defense segments like counter-UAS, that's unmanned aerial systems, and cyber technology. Think about the global need to defend against cheap, ubiquitous commercial drones used for reconnaissance or even attacks.
A very current threat.
Exactly. That's the market they are targeting.
And their acquisition strategy is, well, aggressive is the right word. The planned acquisition of Centrix, for instance, seems like the linchpin.
It really does.
That immediately gives them extensive exposure to crucial Tier 1 defense clients globally who, frankly, need these cyber defense capabilities yesterday.
And the market has certainly reacted. The stock saw a remarkable surge, soaring 577.9% over past 52 weeks.
Astronomical.
It is. But here is the critical challenge. Despite that soaring stock price, their revenue history is still volatile and margins are currently negative.
Right, so how do we justify this massive valuation bump for a company that is still clearly spending heavily just to grow?
Well, that volatility is the essence of the speculation, isn't it? The $425 million capital raise they recently executed, which funds this rapid M&A, that's kind of the answer. Investors are betting that the strategic value of the assets they are acquiring, like the existing defense contracts and IP from Centrix, far outweighs the short-term dilution risk.
So it's a future bet.
Completely. Analysts seem to support this bullish outlook, with a median price target around $7.25. The market is pricing in the future success of a major defense tech player, not its current balance sheet.
Gotcha. That makes the Q3 2025 earnings release on November 13th incredibly important then.
Extremely. Investors will be scrutinizing that report for clarity on the balance sheet strength and how efficiently that $425 million is actually being deployed. Transparency on integrating these acquired companies is absolutely critical for maintaining this rally.
Okay.
Now, let's maybe move from those high-risk, high-reward growth plays to something, well, much more steady and defensive. It offers a critical counterbalance in this kind of portfolio thinking.
Good idea.
The fourth stock is Public Service Enterprise Group. This is a regulated utility stock, offers predictable, regulatory-driven growth, and those steady, necessary shareholder returns.
Yeah, when you look at utility stocks, you're looking for stability, regulated cash flow, reliable earnings, and they delivered.
They did.
Q3 2025 earnings jumped a healthy 26% year over year to $1.13 per share, comfortably beat analyst expectations too.
And their story is really about guaranteed, long-term infrastructure investment. They have a capital spending program planning, $21 billion to $24 billion through 2029.
That's a lot of spending.
It is. And this money is focused heavily on infrastructure modernization, making the grid more resilient, and also clean energy transitions. For PSEG, this systematic spending drives the expansion of their regulated asset base.
Okay, maybe explain regulated asset-based expansion just quickly for listeners. Why does that matter maybe more than just high revenue growth in this case?
Sure. It's really the key to stability for utilities. When a utility spends on necessary infrastructure, regulators generally allow them to earn a guaranteed rate of return on that investment.
Okay.
So that expands their asset base, which guarantees future revenue streams and profit stability. It's essentially mandated, predictable growth tied to essential services. It insulates them from economic ups and downs.
And for investors seeking reliable income, that stability translates directly to shareholder value, right?
Exactly. They provide a strong, well-covered annual dividend yielding about 3.03%.
Decent.
Plus, in an uncertain macro environment, the stock offers tremendous risk management qualities. It has extremely low volatility. Its beta is just 0.61.
Very low.
That low beta provides genuine insulation against broader market swings. Now, it won't give you the 500% gains of a volatile tech stock.
Right.
but it significantly cushions your portfolio if the broader market hits turbulence. We'll get crucial guidance on their fiscal 2026 outlook when their Q4 earnings come out in late January.
Okay, good to know. All right, that brings us to our final company on the list, Red Cat Holdings.
Okay.
This company's positioning as a leader in military and government drone solutions, specifically for ISR, that's intelligence, surveillance, and reconnaissance, and strike systems, is what seems to command strong institutional sentiment, despite some mixed financials.
Yeah, this is another defense technology play, but focused more on air and sea rather than cyber, like Ondas. They recently executed a significant capital raise, garnering approximately $172.5 million.
Big raise.
Yeah. And that money is earmarked directly for aggressive expansion, notably launching a new unmanned surface vessel division. It indicates a strong commitment to scaling up multi-domain defense capabilities.
Okay, but here's the paradox, right? Their recent revenue history actually shows a decline and widening losses, which is usually a massive red flag for investors.
It usually is.
Yet the analyst consensus remains a strong buy, with price targets ranging up to $15 to $16. That represents, what, 50% to 100% upside potential from current levels? Why the disconnect there?
Well, the market seems entirely focused on the future pipeline, not the legacy financials. Defense tech has incredibly long sales cycles.
True.
But once a company secures a spot in a key procurement program like, say, the specific rapid acquisition initiatives the Department of Defense is running for small, swarming ISR drones, the revenue can accelerate massively.
So institutions are betting the capital raise ensures they survive the current cash burn long enough.
That seems to be the bet, long enough to secure those potentially generational contracts.
So the $172.5 million is essentially their working capital to bid for and fulfill those massive future contracts.
That's likely how the market sees it, which makes the Q3 earnings release on November 13th critical.
Same day as Ondas.
Right. Investors need to see evidence that the new defense focus areas, like those unmanned surface vessels, are starting to show some initial success, some contract momentum.
Okay.
And we absolutely must emphasize the risks here. Specifically, the ongoing legal risk related to a class action lawsuit announced in November regarding alleged securities violations.
Remember, that's important context.
It is. When you have a high-growth, aggressively expanding company reliant on market confidence, any legal challenge has a layer of uncertainty that investors must factor into their thinking. It's a classic case, really, of balancing enormous upside potential against very specific material downside risks.
It's definitely something to watch. So to recap, our 5 stocks to watch are Advanced Micro Devices, the AI powerhouse, CleanSpark, the highly efficient mining infrastructure play, Ondas Holdings, the aggressive counter-UAS expansion story, Public Service Enterprise Group, the stable defensive utility giant, and Red Cat Holdings, the specialized military drone player focused on future government contracts.
A solid list that really spans the risk-reward spectrum, doesn't it? From regulated stability to aggressive defense tech.
It does.
Before you make any moves, though, really understand the unique risks embedded in each one. For example, here's something to think about. If the market rotation continues away from speculative growth, how long can CleanSpark maintain its valuation based solely on operational efficiency rather than the underlying price of Bitcoin?
Good question.
That's the kind of question you need to keep asking yourself. As always, do your own research before making any investment decisions. Thanks for tuning in.